Welcome, everyone, and thank you for joining GP Bullhound's Global Tech Market Update. Today, my name is Maria Lazareva. I'm based in our London office, and I'll be hosting today's webinar, where we will look into global tech, M&A, and fundraising activity, as well as how the software sector has been faring, which will then be followed by a presentation on which are the category winners to invest in. From the GP Bullhound team, we are joined by managing partners and co-founders Per Roman and Hugh Campbell, our San Francisco-based partner Jonathan Cantwell, and our asset management team, Ben Pratt and Joakim Dal. We are also extremely pleased to welcome a special guest today and look forward to having Dr. Gero Decker, CEO and co-founder of SIGNAVIO, who will share his experience in building and scaling a successful software business. Before I hand over to today's presenters, I'd like to run over a couple of points with you. Today's webinar will take approximately 60 minutes, and we will, of course, share a link of the recording with you after the event. Just look out for a follow-up email in the next couple of days. Please feel free to drop your questions in the Q&A box during the webinar. We will allow some time at the end of the presentations to answer as many questions as we can, and we would love to hear from you. You can also find more information about our upcoming online events at gpbullhound.com/events, or simply follow us on Twitter or LinkedIn to get the latest news on all of our activities. Again, for those of you who have just joined now, thank you and welcome. You can drop your questions in the Q&A box, and we will send you a link to the webinar's recording in the next couple of days. With that, I'm delighted to hand over to Per Roman, managing partner and co-founder at GP Bullhound, to start us off with some thoughts and observations on the current tech market. Over to you, Per.
Thanks, Maria. Great intro. That's lovely. Here we all are again, looking into a screen, but that's how it is. And I think that in itself has made 2020 an absolute watershed year for the whole digital and technology industry. In fact, in the Western worlds, we spend 4.2 hours a day doing business and consumer activities on our mobile phones, racking up almost $200 billion of revenue to the companies that we invest in doing that. So thanks to all of us for the effort being in front of the screen. And we're forecasting to see revenues in mobile, both in business and consumer, to grow at over 20% a year for the next 5 years, with the fastest growth coming from non-gaming related mobile subscriber activities, which is of course brilliant for the strategies that we run in tech. And then if we then look at the state of the nation at this very moment and the year ahead, what we saw in January was record inflow of capital into equities. I mean, all equities. And of course, a very good portion of that goes straight to growth. We've also seen some healthy profit taking, as particularly Bernstein has convinced many portfolio managers to dip into value investing for a time for some of these kind of post-pandemic recovery sectors. And I think that's provided a good breather for our space. So we're up 4% year to date in the public tech markets, and 53% on a 12-month rolling basis is still very strong. In the private tech market, though, things are absolutely on fire. I mean, every single transaction is oversubscribed, super competitive, and the valuations are high, but it's more now a game of access and a game of value add. So we are, I think, really honing our brand skills and using all our wherewithal to make sure that we can elbow ourselves and our investors in to these super hot, high growth transactions. And then we have certain phenomena now that are really emerging and becoming meaningful. You probably have all heard about SPACs, or these vehicles to basically raise capital in a public setting and then go out and buying one or more several growth technology companies and thereby flipping the company onto the public markets. And what's really interesting with this phenomena is that it allows the larger asset allocators to use their public equity allocation rather than their alternative allocation, where also the return expectations are much lower. That then in turn allow the SPAC managers to pay a higher valuation for the same assets and still deliver against the return expectations of their underlying LPs. And I think we're just seeing the beginning of that, and it's a further blurring of the border between private and public that I think will go on for some time. We then also see an enormous increase in liquidity in the private technology space. So for the later stage private technology companies now, there are at least, we can count 30 highly active brokers arranging bilateral transactions through special purpose vehicles and so forth. Again, allowing public equity investors, hedge funds, large family offices to also dip into what previously had been a domain controlled by a relatively small group of growth and venture investors such as ourselves. And I actually think that change of dynamic is really interesting, definitely very healthy from a founder perspective. I think for us, in some ways, it means we have to stay super disciplined and make sure that we don't get kind of caught into temporary bubbles like we see, for instance, right now in the electric vehicle space. But overall, I think it creates liquidity in markets, and that is long-term good for a free economy. And maybe lastly, what I want to say is that we have seen now and witnessed for a long time this massive shift for both business users and consumers onto mobile. But underpinning all of that is the cloud, is the fact that we can process, manage everything from just an experience to full payment, checkout in the cloud. I mean, imagine during this lockdown, at least partial lockdown we have, if the kids could not have access to school, if we could not have access to work. So I think that is really here to stay. I think a lot of this consumer and business behavior that kind of was created last year, we're definitely going to go back to offices. We're definitely going to go back flying again. But I think the world at large has really got used to these tools and the time savings that are available to you when you so wish. And I think that put us on a very nice growth plane for the next 10 years. So while we are very cautious around valuations and making sure that we use our kind of strategic abilities to get into stories rather than just being a highest payer, I remain with a very positive of the industry at large for the next year and years to come. I think that's my summary, really.
Thank you very much, Per. I believe we have a question for you.
It's Hugh here. Hello, co-founder.
Hello.
So if we go back 20 years to the East End of London when we started GP Bullhound, it was also pretty heady days. And if I look at Tesla buying $1 billion or $1.5 billion of Bitcoin, that in some ways gives me a bit of a cold sweat and takes me back. But do you think things have changed at all, or is this just the same old story replaying?
Well, I think definitely things have changed materially, Hugh. I mean, I today think that digital is an integral part of everybody's both home and business life. We probably couldn't very easily adapt back to the world of 99, 2000 with a mobile phone with nothing on and printers in offices. So I think that's definitely here to stay. At the same time, I think humanity has always proven to be incredibly good at identifying and creating bubbles, temporary bubbles. And we will continue to see that. I mean, we see that in the crypto space right now. It's still a technology that doesn't really have a natural use case of large economic value. At the same time, the idea of a distributed ledger and a non-central system is very strong and probably here to stay, but it will go through iterations. Specifically, the Tesla Bitcoin case, though, is one to worry about, because I think everybody on this call will definitely remember 2008 and 9. And one of the core pieces to that bubble in the collateralized debt market was that the risk got interlinked between the banks. And I think when Tesla bought Bitcoin, you can now argue that, are you buying an electric car company or you're betting on Bitcoin going to $1 million? In either case, you will win, but it's very hard to now pull it apart. And those are things that could be very early indications of us heading towards a more material correction in the market. I don't think there is enough indications yet to play out a doomsday scenario, but I think those are exactly the right signals to study with care.
Thank you very much, Per. We have one more question for you. Are there some specific regions with more or lesser positive impact in tech M&A projects and or deals in the last month?
More or less, sorry, public impact?
Are there some specific regions with more or lesser positive impact in tech M&A projects in the last month?
Well, I think the region that has really fared the best is the US region. I mean, it's been just a massive success for Silicon Valley and other tech regions in US. I mean, it was very clear that the public equity markets in US were really longing to see more technology names move out of the large venture and growth funds into the markets. And we've seen, you know, like the success we've had with Unity, Airbnb, Palantir, Datadog, and you know the list is just almost endless. So that's been tremendous. Also, Europe has fared very well, even though on a much smaller scale. And of course, the story in China has been somewhat different, as there's been some very challenging political wins inside China itself during this period. But in the end, I think for the long run for investors, this is not really a geographic game. It's a game of user adoption, and the technologies are being adopted on all continents. I mean, one of the stories that people spend very little time on, but that we have looked at quite a bit in the last few months, is the adoption of mobile and mobile payments in Africa, for instance. It's a lot more advanced than most people would have thought. So one has to play the geography game with care, but also not getting sucked too much into all the political winds that we see in media today.
Great, thank you very much, Per. Now I would like to welcome our managing partner and co-founder, Hugh Campbell, and Dr. Gero Decker, co-founder and CEO of SIGNAVIO, to talk about SIGNAVIO's success and how to build a software business. Hugh, Gero, welcome to our virtual stage.
Great, thanks, Maria. Hi, Gero, how are you?
Good, thanks for having me.
Oh, it's a pleasure. So I think we've got 25 minutes, I've been told. So we've got a lot to explore in a very short amount of time. But if I may, I'll just introduce you very briefly, and then we can dive into a bit about the history and the scaling of SIGNAVIO over the last few years. So to those of you in the audience, I've been very lucky to know Gero since 2015. Here at GP Bullhound, we were lucky enough to advise him and his co-founders on the investment by Summit, and then again a few years later on the investment by Apax. And in fact, we also invested some money out of our own fund, although as Gero rightly taunts me, it's never quite enough. And then by way of background, Gero studied at the Hasso-Plattner Institute, graduated top of his class, not just in his bachelor's degree in software engineering, but also in his master's, and then went on to do a PhD in business process management. And off the back of that journey, he founded SIGNAVIO straight out of school, and starting the business in May 2009 in Berlin. And the software itself helps organizations, for those of you that are not aware, helps organizations understand, improve, and transform all of their business processes to such a degree that they have about 2,000 business customers, 1 million users, and operate out of 12 countries. And not only has Gero and his team have to manage COVID in this sort of distributed global environment, but he's also managed very successfully to sell the business to SAP just recently for a reported $1 billion valuation. And so this, of course, is a fantastic European enterprise software story. There's not enough of these stories in Europe. So for those entrepreneurs out there, we need to get our skates on. And hopefully we'll tell you a little bit more about that journey this afternoon. So Gero, tell me a little bit about how the business started and how this group of friends and co-founders got together.
Yeah. As you said, I spent some time at the university, even all the way through PhD, and a PhD is a great time because you have a lot of, you can pursue a lot of different ideas. And one of the projects that we started working on was try out what kind of user interfaces you could build in a web browser. And because we were part of a business process centric research group, we had a lot to do with like flowcharts and everything. And we wanted to be the first ones in the world to have a tool that helps people design their organization, their business processes, not from an desktop installed tool, but through an application that comes through the web browser. So I met my co-founders exactly at the university. So I was basically the supervisor, and the others were the students running a project. And we started an open source project. Through that, we're super proud of what we had built. So 2 years in, we asked ourselves, what happens now to the great technology? If we all leave the university now, then it will die. So we started approaching companies out there and asked them, whether they would like to be the guinea pig and try this out in commercial use. So that turned out to be quite successful, and that was the start of the journey.
And tell us a little bit about your first office. Did you start in a euphemistic garage or a student digs, or where did you get going?
Well, we didn't want to work from home, so we said we look at the Berlin map, and we pin right in the middle of all of our apartments in Berlin-Charlottenburg, and we found a great place, the old Imperial Post Office of West Berlin. And there's a funny story to that, actually, because just before we moved in, a movie was shot in our office, and our very room that we rented was the wardrobe for the stars before they go on the set. And the lady, the actress who had her wardrobe in our very room, she actually won an Academy Award for that film later on. So it was Kate Winslet shooting The Reader right next to the room that we were in. Yeah, that was, they removed the last pieces of that movie production the day before we moved in with our little software company.
So there's even a little bit of Twinkle Town in your journey. And so if we skip forward a bit, obviously first office in Berlin, and then I think the next step was into the US. So a couple of questions around that. One, when did you realize you had to be in the US? And then secondly, how did you avoid a lot of the pitfalls, the problems, the holes, the difficulties of getting into the US and selling software, European software to US clients?
Yeah. There's also a funny story around that. So 2.5 years into the company, we were at a conference at a big event, and there are these evening parties, and I had a very busy day. I just sat down at the bar drinking, one drink after the other, and the gentleman next to me, he did the very same thing. So I said, "Well, this must be a nice guy." So we got to talk, and halfway through, I said, "Sorry, I didn't even introduce myself. My name is Gero," and he said, "I know exactly who you are because I am tracking you very closely." And I said, "Oh, sorry, I don't know who you are." And it turned out it was the chief marketing officer of our biggest competitor, Software AG. And he said, in our quarterly, product reviews, we track all of the, most dangerous competitors to us, and you have scored first place the last 2 times around. We can't figure out what you're doing, but the great thing is you only seem to be active in Germany. And as long as you leave us the rest of the world, we're fine, right? You can have a couple of customers of ours. If you leave us, all of the other nice countries, we're in good shape. So the next morning, this was the point in time where we said we need to go international. It can't be that we're only this local company. And honestly, I always love to travel and see the world. And so people told me, well, this was back in 2012. People told me, if you want to build a real software company, you can only do that in Silicon Valley, right? There's no other way, no other place in the world. If you run a software company in Europe, it's just a pet project, right? Nothing more. So you need to learn from the big boys over there in California. So I said, okay, I've never been there. So I packed my bags, move over. I wanted to stay for many months or potentially several years. My fiance was supposed to come with me. Then 2 weeks in, she tells me, guess what? Big surprise, I'm pregnant. You need to come back. So this was the end of my American adventure. And I needed to wrap up things fast and found the ink and hired the first couple of employees. But ever since, at least pre-COVID, I have come back to the US probably every month or every other month. So spending significant time in the US and to meet customers and partners.
Well, I think one of the great things that I took away from our discussion prior to this call was how loyal the founding team and the staff have remained over this journey. So tell us a little bit about how you've managed to do that. And of course, you can't keep hold of everybody either on a journey like this. So maybe you can tell us a bit about both sides of that coin. Yeah,
I mean, in the early days, it was really that SIGNAVIO was everybody's family, right? So you would come in the morning, you have breakfast together, you work throughout the day. We have lunch together, we have dinner together, and only once you get tired, you go home, right? So this would be a usual day. Typically, friends hire friends, the least diverse setup that you can imagine, right? Everybody 25, white, male, engineering background, right? So this was, very special atmosphere in the beginning. And actually the first employee to leave SIGNAVIO, he didn't want to leave, and he came to me and said, Gero, I always have my side projects, my fun projects, and the latest app that I just launched 2 weeks ago just hit 1 million downloads on the App Store. I really think I need to pursue it. And then 6 months later, he had 100 million downloads on the App Store. The app was called Dub Smash. It imploded soon after, so never turned into that social network that they wanted to become. Anyways, but this was the first person who left SIGNAVIO after a couple of years. But overall, I mean, we always, I think, intuitively created that family feel, that it was something, special to be part of the company and to take good care of everybody. Obviously, we became a lot more diverse, a lot more international, a lot more global, but the special feel has still persisted until today. And also out of the founding team for the first 6 years, all founders stayed on board. After 6 years, the first one left. And now 12 years in, or if you count the open source project included, it's 15 years in. We still have Willy and myself, my CTO and myself, still running and still committed to stay on for many more years to come.
And I was very touched by the alumni program, as I said before. In a journey like this, from zero to $1 billion, not everybody is fit for purpose all the way through that journey. But it sounds like you've figured a way of kind of extending the family outside of just being employees.
Yeah. I think we had this discussion. Is it a team? Is it a family? But I'd rather opt for the family, because even if people leave, they never really leave. They come back for the parties, for the gatherings. That many people who were former SIGNAVIO employees, they feel very attached. We even have a word for people who come back. They're called boomerangs at SIGNAVIO, because it happens so often that we even have a word for that. So people who come back either very fast after 2 weeks or 4 weeks, or some who come back after 3 or 4 years and say, well, it was great to see other things, but now I know this is the best place to go to, and I want to be back.
Great. And just changing topics for a sec, perhaps on to funding and exit. I mean, a lot of entrepreneurs nowadays, and perhaps it's because money is so available, so much more available than it was 5 or 10 years ago. They seem to be raising very large seed rounds. In my view, a seed round seems to be what a first round or a Series A used to be. But venture capital didn't play a role in the early parts of Signavio.
Yeah, it was simply not available, right? We started in 2009, financial crisis. Berlin was super underdeveloped as an ecosystem at the time. So we figured that, we rather spent the time with customers than with investors, right? They also give us money, but it's revenue and they appreciate our products. So that's even better than have an investor, right? That you basically need to pay back at some point in some form. So no, for a long time, it worked out well. We were very, cost sensitive, right? Didn't spend much money. It also helped to be based mostly out of Germany. It obviously also helped to have very junior people on the team. We only hired fresh out of the university. Only a lot later, we started hiring very experienced people because we realized that it kept us from scaling and growing as an organization. But this all helped. So at the time when we went on the fundraise with Summit, we had 35% EBITDA while we were growing 65% that year. So it was a very unique combination that we were in as a company.
But let's just dig into that for a second, because that is quite extraordinary. I mean, usually when you're selling enterprise software like this, and quite complicated, not easy to explain software. This isn't like selling accounting software or CRM software. It's a lot more complicated. Usually the complaints from entrepreneurs or VCs is that the sales cycle is so long and so expensive. So how did you manage to accelerate all of that or compress this? I'm really interested to understand more.
Yeah, I mean, when we first went to market and for the first couple of years, we really took a niche that was underserved by the big players. That was mid-sized companies who were not willing to invest, hundreds of thousands for that type of software, but who wanted to have an entry point into that topic for maybe 20K, 30K, 40K. So a pattern that we see now being very usual in the SaaS world. At the time in our space, in process management, some vendors, the sales reps wouldn't even come to you if it's not $500,000 or more, right? So this was a good gap for us to fill in the market to scale quickly, and also to have the time to really round out our product. So by the time we signed on the first big customers, so for example, in early 2013, 4 years into the company, we signed on Goldman Sachs as one of those really marquee milestone customers for us, because they took the usage of our products to a whole new level. We were able to, fly under the radar for a long time. And then with these few early, very large customers to round out the offering so that after 5 or 6 years, we were really ready for prime time to also compete with the big guys, also for the big deals in the market.
And did you manage to get the cash flow of these early contracts right? So were customers paying up front, 12 months up front, and that helped a lot to push back the VC raise?
I mean, to be honest, when we started, SaaS and recurring revenue was not the norm yet, right? So in the early days, we still signed a lot of deals where it was upfront license payment and then the smaller maintenance fee. Only later we switched it entirely. I think only 6 years in, we switched it entirely to subscription only, which is obviously much better for, from a planning perspective, but also from an enterprise value perspective. But in the early days, we also leveraged that hybrid model of having larger cash infusions from some customers, and only gradually switching to subscription only.
Yeah. And then if we roll forward a few years, it seems like the business has found a new home, Gero, with SAP. And given that you studied at Hasso-Plattner Institute, I have a hunch that your relationship with SAP goes back a long way, but perhaps you can tell us a little bit about that and how you've ended up with this new partner.
Yeah. I mean, SAP obviously has always played a role for us. Hasso as the big role model throughout my university times. He actually offered me a job at the time because he had this idea of this new type of database and he was looking for the first people to build it, so which turned to be the HANA database. And it's funny because one of my good friends from university, he actually decided that he would want to follow that path and explore that. And he now ended up as the chief technology officer of SAP. So one of my best friends is he's not my boss, but kind of, how do you say, different business unit, anyways, different board area. So there's a lot of, obviously a lot of friends. So I know the organization well. We have a lot of fans of our topic, very process-minded people. Christian Klein, he was the champion who actually decided to go with Signavio for internal use 8 years ago. So he knows our value proposition, our product, in detail. So when SAP redid their strategy late, in the second half of last year, it became obvious that they wanted to be a much stronger player in the business transformation conversations out there in the market, and they need to have that process agility layer for SAP as well, not to lose out to the ServiceNows and the Microsofts and the UiPaths of the world. So we fit perfectly because we filled quite a number of holes in the portfolio of SAP, and being a very high momentum play on the market, very large following, very large community. So for us, it's a great opportunity to be, I always call it, on the one hand, deeply embedded within SAP, to drive faster adoption for S/4HANA or other SAP products on the one hand, but on the other hand, also have a position to go beyond SAP and drive that process thought leadership position in the market, no matter whether processes get implemented through SAP or something else in the end. So that's a very good position for us to be in. We also have a critical mass to really take our nucleus forward and not just get all consumed up and disappear within the large SAP ecosystem. So I think it was just the right move at the right time for us to become part of SAP.
And you sound very excited actually about the future for you personally, but also the whole company within SAP now. Yes,
I mean, SAP is super dynamic, ambitious, driven by the fascination for the topic that we stand for. So there couldn't be any better starting point for us, and we have a lot of freedom, a big mandate within SAP to make things happen. So now it's also up to us in the next couple of months to prove that the fantasy is justified, and that we can indeed make a big impact on SAP overall.
Great, and then we've got 5 minutes left or so, Gero. And I mean, every time you and I have met over the last few years, you always come across as very relaxed, very much in control. You seem to carry stress very lightly, but building a business like this is not at all easy. I mean, often lonely, difficult. I mean, tell me a little bit about how you've got that balance right between work and life and family as you've built the business. I think it's something a lot of people are starting to talk more and more about now.
Yeah. I mean, on the one hand, I come from an entrepreneurial family, so I also saw some of the disadvantages of being an entrepreneur and being prepared for some things, right? That especially the people side of things is the difficult piece, right? Working on product, the market, customers, right? And this can all be solved, but you need to get the people portion right to succeed as a business. So probably the trick for me always has been to hire very, very experienced people on my management team who know a lot more than I do about the things that matter for our business, right? And let them do their magic, right? I hired Mark, for example, Mark Hornstein, who had led Hybris, and then later on the commerce and CRM division of SAP, growing from a couple of million in revenue to $1 billion in revenue. So obviously with these types of people, also, on the product side and the finance side, everything, it makes it so much easier that I don't need to do all of the groundwork and build the practice and so on and so forth, but can make sure that everything runs in the right direction and that people talk to each other and that one thing fits into the other, and make sure that it feels good for everybody involved as well.
So really putting time and effort and I guess money into that senior team sounds like a critical success factor for that scaling period.
Yeah, plus we were very lucky when Summit came on board. They brought Leo Apotheker as a chairman, and he has also been super instrumental for us to know, what are the do's and don'ts, or what are the levers that we have as an organization, what are the things to focus on, and what are the not so important things. And he helped me craft also the roles, some of the fundamental setup that we needed to make, and make sure that we spend time on the most important things. So that was also super helpful.
What an amazing guy to get as a chairman. I mean, that's fantastic. I mean, it's a good example of where private equity can really add significant value to a business like yours.
That's correct.
And then maybe just the last question before I hand back to Maria. And I know you mentioned to me that you're planning to stay at SAP for many years, but I guess selling your business also gives you an opportunity to think about other things, about charitable activities. I mean, what have you got in mind there? Any particular areas that you're thinking about?
Yeah, I mean, obviously my priority number one is that we safely arrive at SAP, and that things, progress on the right track, right? And that we make a really good impact on SAP. And I figure I have 2/3 of my life left to have the final plan. But some of the areas that are important is obviously fighting climate change. So we're thinking about getting, as founders, getting very active in that space and helping through investments and expertise to get some of the crucial technology in place that we need to reverse the clock, if you will, or at least slow things down, to help our planet live on for a couple more centuries.
Yeah, no, that would be nice. But listen, Gero, I just want to thank you so much for joining us. I think your enterprise software story as a European is something to behold, and something that I hope many people on the call have learned something about. And finding great chairmen, investing behind your management teams, building a strong family alumni network as you grow. I mean, I think these all sound like great tips for the top. So with that, I'll hand back to Maria.
Thank you very much, Hugh, and thank you, Gero, for sharing your insights. Next, I would like to ask Jonathan Cantwell, partner and head of software at GP Bullhound, to share some of his insights. John, over to you.
Great. Thanks, Maria. Hi, everybody. Good to be with you today. Coming off of the SIGNAVIO story, we'll continue in the enterprise software sector here. And we'll give you some trends we're seeing in the market. We're out talking to a number of CEOs, entrepreneurs, investors every day, and kind of gathering our thoughts here. As many of you know, we do a quarterly SaaS report that goes into a lot of depth around trends and qualitative thoughts that we're seeing, not just the data, although we have that in there as well. And these are really the five biggest, most important trends I think we're seeing across the SaaS space currently. The first one being privacy, and that taking precedent over a lot of other things in the code base and the platforms that companies are building. I think Zoom is a big example of this, having to make sure everything is very secure and privacy is front and center for them. The next one we're seeing a lot is big data getting a synthetic makeover, meaning that data that organizations and enterprises capture on a daily basis, it's getting to be more massive and massive every day. So making sure that's kept in a secure way and also is being offloaded off of the infrastructure is really important, and is very manageable for data officers or CIOs within the organization. Number three, small, medium businesses undergo radical digital transformation. Yeah, I think we started to see this on the enterprise level a few years ago, and now is really front and center for SMBs. I think COVID has accelerated things by probably 5 years for SMBs, and they're buying more and more software. they're running their businesses in the cloud and digitally, which is great, and requiring an upfront investment by them as well to make sure that everything is locked in on the software side. For embedded analytics and data insights, again, there's just so much data out there that the analytics of it is really important. I think we're seeing this across the social space, across the e-commerce space. Companies are looking from a B to B to C perspective on what consumer analytics are telling them. They're listening to that, they're acting on it. Really exciting sector that we've been paying a lot of attention to over the last several years, and certainly now. And then finally, one more to note: enterprises go serverless, and that's a bit of a misnomer. They don't actually, not have servers, but that's being done in a much more efficient manner, through the likes of AWS and Azure. You're starting to see that as well, and it helps again both with the cost efficiencies, effectiveness of enterprises, putting virtually everything into the cloud. So some great trends we're seeing. I think this is exciting for the startup universe and also big players across the tech spectrum. As we go to the next slide, we'll start to look at how a lot of the software companies are trading. And I think if COVID has shown us one thing, it's that software companies are worth a lot more than anyone ever thought, which is amazing. So you can see some of the top quartile public software companies out of our index here, trading on average at 30 times last year's revenue, 25 to 28 times 2021 revenue. Many of these are not profitable. Some are, and then all of these are growing pretty quickly here. So, on average, 35+% in terms of revenue growth. Gross margins in the 75% range. Obviously, Zoom has been kind of the darling at, that they're expected to grow this year over 300% off of last year, which is amazing. And they've turned very profitable, 17% EBITDA margins. But there's other great businesses here like Wix, which reported amazing numbers a couple of weeks ago. That's a pretty big business in the kind of start your own website space and things, features around that. Sprout Social has been a darling of the social space, and they're trading close to 30 times revenue. Has been more of an SMB story, but has migrated to enterprise. So a couple of examples of where businesses have really excelled over the last year in the top quartile of SaaS businesses. As we go to the next slide here, you can see, I think all the market activity has really resulted in a flurry of M&A deals and big deals. $1 billion plus M&A deals are becoming more common. Strategics making strong plays to, like, for example, Workday buying Peakon for $700 million or so. Citrix bought Rike for over $2 billion. That's a collaboration software company, kind of similar to Slack. Slack obviously got acquired, a company we invested in a few years ago for $30 billion. And that was at I would say a modest revenue multiple of 30x. So a lot of mega deals happening. Again, I think the big strategics, are making plays here, given their currency is worth a lot more, and they see some exciting startups coming up that can really help them in their go-to-market and kind of rounding out their software platforms. And then I would also mention the private equity firms have been very active. So Vista, buying Gainsight for 11x revenue. We've seen private equity firms paying into the teens on revenue multiples as well for high growth businesses. And next slide, please. So some of you have seen this chart from us. It's in our quarterly report. We've shown it in some other webinars, but we take about 75 companies in our SaaS index and we track them. We've done it, over the history here, going back 5 years on this chart. If you look into the COVID period on the far right, it's pretty interesting. There was obviously a huge run up throughout last year with a few dips. but consistently, up and to the right. The software index is trading at 14.5 times forward revenues and 18 times trailing revenues. And you can see it's actually in the last week, starting to come down, maybe normalize a bit. I think it's been up though this week. Last week was some drops. So we may be hitting kind of a plateau point. But again, I think we're in a time period where software will continue to grow and be very valuable. Probably healthy that things are maybe moderating out a bit and still trading in the mid to high teens in terms of revenue multiples for public companies. And here, when we break down a few of these top SaaS companies in terms of growth rates, and you can, if you're running a private company, or if you're investing in private software companies, you can kind of compare your metrics here. You can see on average, these businesses are growing 36% year over year. You have the high flyers like Snowflake, Cinch, even Square here in terms of the 2020 growth. But in general, these guys are all consistently trading, 30% or above in terms of growth, and at very massive scale. So billion plus in ARR. I think Zoom reported numbers yesterday. They're now doing 4 billion a quarter of ARR, which is remarkable. Next slide. So when you start to think about, actually making money for these companies, free cash flow, certainly growth is done at a premium. But at the same time, you have investors still willing to underwrite losses. If you look at the right side, companies like Snowflake burning money, Asana, Sprout Social burning money. And, if their other metrics are best in class, then there's no hesitation to continue to invest in them, buy the equity, run up the stock in hopes that they eventually flip to the left side and are both growing, high gross margins, high EBITDA margins. Net retention is something we've dug into a ton over the last couple of years, both in terms of the public companies as shown here, but also as private companies. It's now, I think, up there with revenue growth as the top two metrics for valuing a software business. Hugely important to be above the line, meaning above 100% as you add and upsell, upgrade your revenue amounts. So from a net perspective, if you're able to add more than you're losing, obviously that's a good thing. I think it really depends on the end market. So marketing software companies tend to have lower gross and net retention numbers. Sprout Social has done a nice job there at 110%, as you can see. And then the infrastructure, a bit more mission critical products like ServiceNow, Snowflake, Twilio are much higher. So interesting data to look at. I think it does get to be a bit scary when the numbers get low, as in well below 100%, and you start to hear terms like a leaky bucket in some businesses, and that's something to fix right away, we think. This is actually something we made up, and we thought it was quite clever when you look at it. We're calling it the GP Bullhound SaaS score. So you're taking kind of the rule of 40 as a basis, so revenue growth plus free cash flow margin, and then you're adding the net retention percentage to that. So those three percentages equal what you see on the screen for these companies. So you're basically including net retention into rule of 40 and seeing how that's yielding different revenue multiples. So you can see it is pretty consistent. The companies with a high GPB SaaS score are trading higher in terms of revenue multiples, and Snowflake and Zoom being two of the highest there. And then going back to the rule of 40, we have this data here. I think most people in the software space are familiar with it, but when you look at and you kind of chart revenue growth versus free cash flow margin, we do think it makes sense to invest. If you have $1, dollar, pound, euro to invest in the company, it should be through to growth, but also factoring in free cash flow margin being an important metric and barometer, especially as you think about different risks in the business longer term. Here you can see the green dots are the companies that achieve the rule of 40. The black dots are the ones who do not. And then on the next slide, you can see where the green companies trade. And for the most part, the data is a little scattered here, but for the most part, they trade at a higher revenue multiple than others. So again, something to look to achieve. And I know the private equity universe looks at this very closely. So something you want to achieve in terms of kind of balancing out both revenue and EBITDA. We have a couple other slides here we won't talk to in too much detail, but just data on that top quartile of SaaS companies, and kind of breaking them down between, are they a vertical play like AppFolio or Viva in the healthcare space, or are they a horizontal play across all different departments? This you'll see in future SaaS reports from us, and we're always happy to get on the phone and walk through some of this and compare contrast to maybe businesses you're working on. So don't hesitate to reach out, but this is what we wanted to present and kind of walk through across the software space. So good to be with you all, and happy to take questions as we go. I'll turn it back over to Maria.
Thank you very much, John. With that, let me hand over to GP Bullhound partner in the asset management team, Joakim Dal, for an update on performance of our funds 4 and 5 and latest investments.
Thank you so much, Maria. And I'm going to make it easy for you all here and actually continue on a familiar topic. If I can just get this screen share to work. There we go. So on SIGNAVIO, which is one of the exits from Fund 4 this quarter, we're very happy for that and congratulate Gero. It's been a great ride with him, and sad to end it here. And if we're going to continue with him, we'll have to do it in the public market. We also had another exit this quarter in Unity that listed on the stock market back in September last year. Has had an amazing ride on the stock market. This is really one of the 2 engines out there that powers the whole gaming industry. And as more people have been forced to stay indoors, more people have gone to games as a way of entertainment. And we're investing a lot in this space now in gaming infrastructure, and have another exciting company to talk to you about that in a minute. But with those 2 exits, and of course the value creation that is happening in this very positive market, we've seen the funds develop in this way over the past year. So really strong development across from Fund 1 through to Fund 3 and 4. Fund 2 is closed, I should say here for disclosure, but just showing that for transparency. And we've had some great companies really delivering on this return, like Unity and Slack previously, as John talked about. And then if we look into the Fund 5 portfolio, I think this is a great portfolio that we've been able to assemble. DuckDuckGo, the leading player in privacy for people. As more people go online and leave their footprints online, they're also concerned about what happens with those footprints and how is my integrity and personal data dealt with. Vivino, the leading wine marketplace globally, about $250 million GMV at the moment. We invested in around there together with our friends at Kinnevik, e-commerce specialists, and we're looking forward to help Heine and his team develop that company to further greatness. I mean, this is a $300 billion plus market. So, I mean, scratching the surface is really the right expression. Glovo is another company that we're investing in from Fund 5. This has been a investment also in our previous portfolio of Fund 3, and it's been performing really well. Oscar and his team, and we're really betting hard on groceries and convenience that is helping people tackle their everyday problems, not just during COVID, but before and after, getting all the hours in the day to fit together. Global really helps with that, solving your food issues. We're also investing in Discord, another topic on gaming, so the leading communications platform for gamers and the dominant platform for gamers. And now this is also branching out to other verticals. So excited about what's going to happen there, and many more. I had some more slides here, but I think given time, and I'm really excited to hear about the Q&A. So I'm going to stop there with the Fund 5 portfolio and give it back to you, Maria.
Thank you very much, Joakim. Well, looking at the time, I think this is all that we have time for today as we reach the end of our session. I'd like to thank Gero and all of our presenters for their time and their thoughts. And thank you to everyone for joining us. Hopefully we were able to answer some of your questions. However, if there is anything you would like to ask our panelists, please feel free to reach out to anyone from the GP Bullhound team. You will also receive a follow-up email within the next couple of days with a link to a recording of today's session. And yeah, we look forward to welcoming you on again very soon. Thank you and have a fantastic rest of the day.